Buongiorno, ben trovati. Siamo al 25 gennaio, però mi permetto ancora di fare gli auguri buon anno a tutti, anche se siamo quasi al limite ormai. Ben trovati. Che dire, grazie alla partecipazione. L'idea è quella ovviamente di essere sempre presenti anche con questa tipologia di eventi che stiamo cercando di fare.
Types of events we are trying to organize. We were here last year at the beginning of the year in trying to give you our vision, an idea of what's happening on the markets, and also to provide you with some investment ideas. We try and do this through these events, and we also try and do it with new communication means. We are going streaming today, and for those of you who want to follow the content at a later stage, you can go back to it and stream it. So the idea is that of being more and more present and provide you with something more. What are we going to look at today? And just to give you an idea, what is the agenda for today? Well, basically, the idea is that of trying to give you our vision. And to do so, we asked Paul Diggle-to-Camp. Paul is one of our senior economists within Aberdeen Standard Investments. What we're trying to do, as you know, since last year, the merger with Standard Life Investments has been completed. And today, we have one of the biggest structures on the side of macroeconomics. Paul is part of a structure with 35 people, 16 macroeconomists and a series of analysts. And the idea is that of providing you with ideas, with tools as well to carry out different analysis to understand how asset classes fared and what will happen in the future. And this is something that's used also in a tangible manner by Mike's group, the multi-asset team. So just to give you an idea, we'll have some introductory remarks with Paul. Then we'll zoom on to something we very much like and which is always and has always been present and has always been one of Aberdeen's expertise, i.e. Asia. Donald Hampstead, for those of you who already know him, is somebody who's been with us forever, basically, and he lives in Singapore, and he can give us his vision of this part of the world, which we believe is of fundamental importance and which is very little represented in very many indices, but which represents a significantly growing area. And then towards the end, we'll have Mike Brooks. If Don will talk about say conventional investments, market growth, long-term trends. Mike instead will try and give us a vision of what they think are asset classes to be taken into account in this moment where markets are faring quite positively, but at the same time we're all expecting some sort of downturn. So as I was saying to some of you before, 2018 started as 2017 did, so no news, good news. That's the basic idea. But at the same time, we've got to be a bit more careful. And then we will close again with some commercial ideas to try and provide you with some practical ideas. In your folders, you'll have some material. We'll go back to this as well. There too, we've made some changes in the range of products we have. But we're going to talk about this later on. And for those of you who want to stay for lunch, we can go into further detail. Once said so, before leaving the floor to Paul, in the past, I have shown to you an indication about the company, what's the assets under management. Well, this time we decided to do this in a more interactive manner because videos at times are a bit more attractive. So to allow you to understand what the merger has generated and what's the importance of the group is today, we'll show you a video. So please, let's start with this brief video clip to introduce what Aberdeen Standard Investments is today.
E così anche spiegato dove viene
And
il
so
logo.
we also explain where the logo comes from, because you might wonder and have some doubts about it. One said so. As I was saying before, I leave the floor to Paul, who will guide you through the vision of what's happening on the market today. To you, Paul.
Well, thank you, Tommaso. Well, as I'm
Grazie,
sure
grazie, Tommaso.
you've heard, my name is Paul
Come
Diggle. I'm a senior
avrete
economist at
sentito,
Aberdeen
sono senior
Standard.
economist ad
My
Aberdeen
job is to
Standard, sono
ensure
Paul Diggle,
that top-down
e
thinking about the
cercherò
global
di darvi una
macroeconomy is
visione
embedded in our investment
dell'economia
portfolios
macro
and our
che fa parte
investment
del nostro
decision-making.
portafoglio e le nostre decisioni di
And what I want to
carattere
talk about
di
today is
investimento. Quello di cui vi
the
vorrei
economic
parlare
outlook as
oggi
we move into
è il
2018.
fatto
And in
che
particular,
stiamo
what I see as
muovendoci verso il
the
2018 e
primary
io
economic and
vedo
investment
che
question as we start this year: will the Goldilocks global economic environment continue in 2018 or not? So what do we mean by Goldilocks? It means that global growth is very strong. Despite the strength of global growth, inflation has been quite subdued, and that combination has meant that central banks are tightening, but only very gradually and only very cautiously. And this means that the world economy is not too hot, not too cold, but just right for a lot of assets, in particular risk assets, to do very well. So as we head into 2018, we must ask ourselves, will this continue or not? I think that is the primary investment question at the start of the year. So let's review how we got here, review how Goldilocks have been so far. Pillar number one of Goldilocks is decent global economic growth. So over the past year, the global economy has experienced a synchronized upturn in growth. And the chart on the left shows you that. It shows you global growth has returned to something like the norms of the past 20 years or so. Nothing spectacular by pre-crisis standards, but certainly better than that period of very sluggish global growth that characterized most of the post-financial crisis period. Global trade has also picked up significantly. So if you look at various measures of global trade, freight traffic, air freight traffic, you see a synchronized pickup in growth, which has boosted the exports of a lot of economies. What's driven this upturn in growth? Well, I think actually it was first and foremost a China effect. So I don't think people realize quite how strong the Chinese economy was in 2016 and 2017, when Chinese authorities added a lot of monetary and fiscal stimulus to their economy. I think that's what really got the global cycle motoring at the start of last year. But it hasn't just been a China story. It's been a synchronized story. So the US is doing very well. The labor market in the US is very strong. Unemployment is falling continuously. There are steady job gains. And that means that consumer confidence in the US is pretty strong. The investment cycle is finally turning up in the US as well. And I think that Trump's tax cuts will add some more impetus to that cycle. EM outside of China is doing very well as well. So those economies have benefited from earlier structural repair work, reduced exposure to the dollar. And in fact, the dollar's been weak over the past year, so that's been a further tailwind for a lot of EM economies. But the real standout performer that's driven the synchronized global upturn has actually been Europe, and that was the big upside surprise last year. We see the Eurozone manufacturing PMIs, they motored ahead last year. Partly Europe benefited from the fading of some political risks, so things didn't go, quote, wrong in Italy, in France, in the Netherlands. It's benefited from the strength of export growth and the world trade recovery. But I think first and foremost, the primary driver of the Eurozone recovery has been continuously loose and stimulative monetary policy. Who knew that if you keep monetary policy loose for long enough, it actually works? Okay, there's some negative spillovers that you have to take into account, but it actually works. And what happened in Europe is that the credit channel got working again. We know that Europe is a heavily banked economy. It's reliant on its credit channel. And finally, lending growth took off again and credit conditions started to loosen in Europe last year. So pillar number two of Goldilocks is subdued inflation. Despite the strength in global demand, inflation actually fell back slightly last year. And partly that was to do with one-off idiosyncratic factors, So wireless telephone costs in the US, for example, experienced a one-off fall. But there are also deep structural reasons for why inflation has been quite weak. And in particular, it seems that economies are simply able to sustain much lower rates of unemployment now than in the past without generating wage and price inflation. And the sensitivity of inflation to dwindling slack is much reduced. So as economists, we call this the flattening of the Phillips curve. That relationship between slack and inflation has been reduced because the bargaining power of labor has been reduced by deunionization, by competition with automation, by competition with a global labor pool. Inflation expectations are very subdued. And it also seems that the pricing power of firms has been reduced. And this is the so-called Amazon effect. So whatever market you're in, you're basically worried that Amazon or Google could enter your market at some point. And this is a structural weight on your pricing power. Pillar number 3 of Goldilocks was very cautious central bank tightening. Actually, in the emerging markets, central banks weren't on a one-way course to tightening. Some were loosening. But in the developed markets, we saw some gradual rate rises from the Fed, and we saw the beginning of balance sheet runoff. But balance sheet runoff was taken remarkably well by the market. There wasn't this tantrum-like response in markets that caused equities to sell off and bond yields to spike substantially. And that was because the Fed did, in retrospect, was a very good job of communicating its balance sheet runoff program. It's very steady. It was well signaled ahead of time. It's passive. And we know that the Fed could pause in its rate tightening cycle if it sees some negative spillovers from balance sheet reduction. And expect other central banks, expect the ECB to be learning lessons from this, this success of the Fed in reducing the size of its balance sheet. So put those three things together: decent growth, still subdued inflation, and central banks that have been tightening but only very cautiously, and you get what we call the Goldilocks environment. So an environment in which asset market volatility has been remarkably low, and a lot of asset markets have done very well, in particular led by risk assets, by EM equities, by Eurozone equities as two standout performers. And what strikes me at the start of 2018 is that it's actually the overwhelming consensus amongst investors that this will continue in 2018. It'll be another year of Goldilocks. And when we look at surveys of fund managers, the Merrill Lynch Fund Manager Survey, it tells us that most managers are taking higher than normal levels of risk, and they're very confident that the Goldilocks environment will continue. And here actually is a few screenshots of all the research I receive in my inbox, all asking this question: will Goldilocks continue in 2018 or not? That is the investment question of the moment, and we have to be able to answer that question to then make our investment and portfolio decisions. And you know what? I find myself answering in the affirmative, that yes, Goldilocks probably can continue in 2018. As an economist, it's slightly painful to find myself inside that consensus view, but I think it's probably the right one, albeit with a number of caveats that I will go on to explain. So let's think about pillar number 1, the global growth outlook. How do we think global growth will perform in 2018 and beyond? And I actually expect 2018 to be an even stronger year for global growth than last year. You know, the strongest post-crisis year after that initial bounce out of the crisis. And I think that the US will be an important driver of global growth this year. And when I look at the incoming US data, I see an economy growing substantially above trend. I think the tax cuts, although they're far from perfect, add further to momentum in the US economy. I think that the Chinese economy is probably going to slow a little bit this year. I think that's widely known. But I think any slowdown will be fairly modest. So I think the shift in the Chinese political economy environment away from growth at all costs and always hitting these very substantial growth targets towards the quality of growth, environmental protections, reining in some excesses in the shadow banking sector will cause a modest slowdown in growth. But I think the Chinese authorities have shown us that they have the tools at their disposal to engineer a pretty soft landing for Chinese growth. EMX China, and Don will talk about both these economies in much more detail after me, EMX China to me looks like a very encouraging story. So increasingly a domestically driven and service-driven story. You know, China, Malaysia, Philippines all are now much less of the export-led economies they once were and have much more positive domestic drivers. There's a lot of positive reform story in emerging markets, and Don will talk about India, where there's a particularly positive reform story. So I think these economies are set to do quite well in 2018. And then we come to the Eurozone and Japan. I think we probably saw the best of the recovery for the Eurozone and Japan in 2017, simply because growth was so far above potential last year. But I still expect 2018 to be pretty good years for both those economies. And that is because monetary policy and to a lesser extent fiscal policy is persistently stimulative. Those policymakers are doing the right thing to add stimulus to their economies and finally get them growing, and they are both growing at substantially above trend rates. So that's my baseline view of growth this year and beyond. But you know, there are certainly risks around that view, and I think that a lot of the risks now are to the downside. And this speaks to avoiding complacency, about not trying to get too caught up in that consensus narrative that this year is going to be another great year for the global economy, because there are a lot of risks around it. And 2 or 3 downside risks that I would highlight to you is, one is perhaps we're wrong about China. Perhaps the slowdown in growth that we see there is a bit more substantial than we expect. Perhaps it's not the case that policymakers can perfectly engineer a soft landing in the Chinese economy. I think that is a substantial risk. We know there's a large debt build-up in China. We know there are excesses in the housing market, in the shadow banking sector, and it could be that growth there slows more than we expect. And that's a risk that we continue to monitor, and we continue to look at the incoming data there. Another risk, much closer to home, is in Europe and in the Eurozone, and is the fact that European political risk, which we were all very worried about at the start of last year, hasn't subsided completely. And I'm always wary about talking about the politics of a country in that country to an audience that know much more than me, but it seems that one obvious source of political risk in Europe this year is the upcoming Italian election at the start of March. Now, again, I'll be very interested to hear thoughts from a much more informed audience than I, but it seems to me that some of those risks have reduced in the past few months, so the chances of a five-star movement anti-Euro government, I think, have reduced somewhat with the centre-right coalition under Berlusconi. I still think the most likely outcome of the election is a grand coalition of the centre-left and centre-right. It strikes me that that's not an outcome that will deliver the much-needed reform that the Italian economy needs, but it's also not an outcome that is the sort of existential Eurozone threat scenario that we experienced in the Greek crisis, for example. So certainly it's not the scenario that involves, you know, even the threat of Italy leaving the Eurozone. But that risk is not non-existent. There is some tail risk there. And there are other obvious risks in Europe as well. Merkel hasn't yet formed a government in Germany. I think the market is fairly confident that she will. You know, the SPD now seem to support formal negotiations, but she hasn't got there yet. Even if she is the Chancellor for a 4th term, increasingly we seem to be in a post-Merkel age, so in an age in which her authority and her leadership of Europe are somewhat diminished. I think that has a lot of implications for the Eurozone project. We all have a lot of confidence that Emmanuel Macron will deliver much-needed European reform, will bring Europe closer together, and there's therefore plenty of scope for us to be disappointed as well. In Eastern Europe, we see the rise of a number of illiberal democracies, of countries that are slowly drifting away from the European consensus of open democracy. Romania is the latest example, in Hungary, in Poland. And I think that's also a worrying development, have a slow burn worry for Europe, the European project as well. So this is a growth picture that's not without its risks, and a lot of those risks, I think, are on the downside. What about inflation? Well, we expect global inflation to pick up modestly in 2018, led by a pickup in US inflation over the next 6 months or so. Dollar depreciation is an inflationary force now in the US. The rise in global oil prices is a bit more of an inflationary force. I think it's an underappreciated development that shale oil no longer caps global oil prices. So investors used to think that once oil broke $50 or $60 a barrel, shale oil producers simply turned back on shale oil production. And that hasn't been the case. So it seems that a lot of the low-hanging fruit of shale production has now been picked. And it's much harder just to ramp up production again and cap global oil prices. So that rise in oil prices is now somewhat of an inflationary force. Most fundamentally, however, labour markets around the world are tightening. So unemployment rates are falling. Unemployment's probably going to fall through 4% in the US soon. And that's very gradually putting upward pressure on wage and price inflation. Only very gradual, because as I said, there are deep structural forces that have reduced the sensitivity of wage growth to economic slack. The reduced pricing power we as workers have, the reduced pricing power businesses have, the fact that inflation expectations are low and ingrained at low levels. But gradually there is some upward pressure on inflation. Again, however, there are risk scenarios. And the risk here seems to be a breakout of inflation to much more rapid rates than we expect. So perhaps it's the case that oil prices keep rising, above 80, say, and that's a significant inflationary force for the global economy. Or perhaps it's the case that once labour markets fall through full employment, wage and price growth takes off much more rapidly than we think. And as economists, we call that the accelerationist theory of the Phillips curve, this idea that wage and price inflation just grows much more rapidly beyond a certain rate of unemployment. And the final tenet of Goldilocks has been very gradual monetary policy tightening. We expect that to continue in 2018. So I think the Fed may raise rates 4 times this year. It will continue its balance sheet reduction. I think the ECB will stop asset purchases before the end of the year. I think it will start raising rates in 2019. I think the Bank of Japan will remain committed to its yield curve target, but it may raise the yield it is targeting slightly on the 10-year JGB. But all that speaks to an environment of still very cautious central bank tightening, of central banks being very aware that they don't want to derail the market recovery and the broader economic recovery. But again, there are risks. There are very obvious risks. This is an unprecedented withdrawal of monetary policy stimulus, particularly the reduction in global central bank balance sheets. And the chart on the right shows you monthly purchases by the major global central banks. And one reason why Fed balance sheet reduction has been taken so benignly by markets is because it is still being more than offset by ECB and BOJ asset purchases. But that changes by end 2019 into 2020. If the ECB stops purchasing, if the BOJ continues to taper down asset purchases, then we actually move from an environment of global quantitative easing to something more akin to global quantitative tightening. And again, that is an unprecedented monetary policy experiment. We don't know exactly how markets will digest that regime change. And you also have to think that markets are probably somewhat more vulnerable to a shock from monetary policy tightening, given where valuations are. And we know that markets are somewhat expensive. And we ourselves run a lot of scenario analysis in which we test the sensitivity of portfolios and the sensitivity of the macroeconomy to these kind of shocks. On the right-hand side, you see a scenario in which we shock the 10-year bond yield to rise above 3.5%, closer to 4%, and I think that could have significant negative implications for a lot of the kind of very benign market environment we've seen over the past year. So my conclusion really is that I do expect 2018 to be another Goldilocks year. Perhaps it's slightly harder to sustain Goldilocks because output gaps are closing. So it's harder to sustain above-trend growth without generating inflation. So I do expect some pickup in inflation, but only modest because the structural relationship between inflation and slack has now flattened so much. And I do expect central banks to continue tightening, particularly in the developed markets. But again, they have learned a lot of lessons of the taper tantrum. They've learned the lesson that they must forewarn markets. They must be very gradual in the pace at which they reduce their balance sheets. But around that rather benign central case picture, I think there are quite a lot of risks, and we do well as investors to take account of these risks and position accordingly. And it seems to me that given how positive the baseline story of the world is, a lot of the risks now are to the downside. Higher inflation, a breakout again of populist pressure. Perhaps Trump, having passed the tax cuts, turns his attention to protectionism. We've seen certain straws in the wind that suggest that he's changing his focus to a more protectionist agenda in the past week or so. Central banks are walking a tightrope with their reduction in the size of their balance sheets. And the past historical parallels are not particularly encouraging. The 2013 taper tantrum, 2006 Bank of Japan quantitative tightening, both resulted in adverse market shocks. So the central scenario is quite positive. The balance of risks is probably to the downside. But because it's good to end on a positive note, I think there are upside risks as well. And as investors, we would do our clients a disservice if we ignored upside risks and didn't participate in upsides as much as if we misparticipated in downsides. And the primary upside risk, it strikes me now, is a resurgence in global investment growth and capital expenditure. And we've seen some signs of that finally the investment cycle is kicking in and productivity growth is expanding again. And that would allow the Goldilocks scenario, the global recovery, to continue for even longer, to extend the length of this bull market. And with that, I want to hand over to a colleague who has a lot of much more positive things to say about a very encouraging part of the world in Asia, which is my colleague Don Amstad.
Buongiorno a tutti. Happy New Year, and as we are going to say in China very soon, Gong Xi Fa Chai, because it's Chinese New Year in a couple of weeks, and it's the year of the dog. I don't know what that means for markets yet, but not the most auspicious start. But I do want to first of all thank Paul for his wonderful global macro introduction. Also to Tommaso and the team in Milan for inviting me all the way from Singapore. And I come to you from Singapore via China. And I am still in a state of shock because I was in Beijing and there were blue skies over Beijing. It was incredible. The last time I was in Beijing was 3 years ago, and I landed on a Sunday. And there is an index of pollution provided by the World Health Organization. It's called the PMI. It's not the PMI that Paul gets excited about and other economists. It's a pollution index. And the World Health Organization recommend that this index should not be above 30. Above 30 is dangerous. Now, a typical day in New York apparently is 17 or 18. This day 3 years ago when I landed in Beijing, the index was at 975. You would not even be able to see that building. It was terrible. And even in a hotel like this, The rooms were full of pollution because all the air conditioning systems in a hotel do is pull in air from outside. And the filters couldn't cope. And I was ill for about a month afterwards. It was shocking. You couldn't exercise in a gym or swim. You had to walk slowly everywhere. You tried not to breathe. So I was so shocked. And I drove through Tiananmen Square. And I looked up. Blue skies. Never seen before. White, fluffy clouds. And of course, the roof of the Forbidden City in Tiananmen Square was painted red. And Beijing was looking fantastic. And of course, the city had been made very clean for the 19th Party Congress that had happened in Beijing in November. Now, as you can tell by my accent, I'm British. So I was also a little bit upset because in Tiananmen Square, there was the Chinese flag and another flag of another country with whom Britain is not so friendly. Macron was in Beijing, and the tricolore was flying, the bleu, blanc, rouge, bleu ciel, blanc nuage, rouge toit, the blue sky, the white clouds, the red roofs of Tiananmen Square. And I was thinking, we should have had the Union Jack up there, but maybe next time. Anyway, it made me think about what is happening in China. And there is extraordinary change going on in China again today. And the change in China today is away from quantity of growth to quality of growth. And I want to talk to you about this because this change is incredibly important. 2018 marks the second major turning point in China's historical drive to become a leading developed country by 2050. This is what Xi Jinping is trying to do. They want to become a developed country by 2030. And the vivid blue skies I saw over Beijing were real enough. And I think blue skies over Beijing is both the new reality and a wonderful metaphor for what is happening in China. The investment implications for you and your clients are profound, and the opportunity for companies like Aberdeen is incredibly strong as well. Now, the first turning point in China's history after the 1949 end of the Civil War, which the Communist Party won, was back in 1978, exactly 40 years ago. Deng Xiaoping took his famous tour of the southern provinces. He went down to Guangdong, which is the province just behind Hong Kong. And this marked the move away in China from communism to capitalism with Chinese characteristics. And since then, the country has experienced 40 years of rapid economic growth that has lifted hundreds of millions of people out of rural poverty into some sort of urban middle-class lifestyle. GDP per capita in China has risen from $100 to $8,800. In the same time period, India has gone from $100 to just $1,800. In China today, there are 500 cities that have more than 1 million inhabitants. Yes, that's right, 500. How many can you name? Go on, try it. Get a piece of paper out and a pencil and see how many you can write. I got to 20. Not very good. But when you get stuck, then you can go to Google and you can get the answer. Now, the philosophy of the Chinese Communist Party, CCP, has run like this. We are an illegitimate government. We got into power because we won a civil war, not because we were elected or chosen by the people. Now, to be legitimate in the eyes of 1.3 billion people, the CCP needs to do something to make their lives better. Now, it's difficult to provide basic services like education and healthcare if you have 1.3 billion people living in villages in the countryside. So they decided to urbanize, to move hundreds of millions of people into the cities. But obviously, if you move people into the cities, they have to do something. So you have to create jobs. And to create jobs, you build factories. And these factories have to make things. But who's going to buy all the output from these factories if people in China are poor and incomes are low? Well, you have to find rich people. Where are rich people? They live overseas. So the country went down a path of export-led growth. And it worked. And it was incredibly successful. And the Chinese Communist Party survived. Fast forward 40 years to today, and the challenges facing the Chinese Communist Party now are completely different. There are labor shortages across China. Now, there are several reasons. The labor-intensive service sector accounts for more than 50% of GDP. You've had the one-child policy. So China has also got very bad demographics. It's aging. The labor force is shrinking. China was at peak labor in 2014. But in 2018, somewhere between 3 and 4 million people are going to leave the labor force. And the number of people leaving the labor force every year for the next 20 or 30 years is going to rise. The point of this change is that the previous policy of generating rapid economic growth to create jobs in cities is finished. It's over. It's redundant. The future legitimacy of the Chinese Communist Party now depends on their ability to improve the quality of people's lives. So, as confirmed by President Xi at the 19th Party Congress in November, the Chinese Communist Party is moving away from focusing on the quantity of growth to caring about the quality of that growth. And now, slower economic growth is quite acceptable politically. This is a huge change. So what does quality mean? Quality means so many different things. It's about the environment. It means clean air, drinkable water, and uncontaminated food supplies. It's about higher paying jobs, which is about moving away from made in China to designed in China. China is way ahead of the West now in so many technological respects. Just as India bypassed copper wires in the ground and went straight to mobile phones, so China has completely bypassed credit cards. And it has gone to a payment system that is almost entirely now based on mobile phones. Quality is about taking holidays and being able to travel both within China and overseas. 10 years ago, 5 million Chinese went overseas for a holiday. Last year, that number was 130 million, and that still leaves 1.17 billion people hoping that it'll be their turn in 2018. But it's also about quality in the financial system. Because with an aging population, people are going to be relying on income from pensions and savings. Now, historically, China has had a financial system that has forced savers to deposit cash in state-owned banks that have paid them below market and below inflation rates of interest. And then these banks have lent money to state-owned enterprises at mates rates, at rates that bear almost no relation to the creditworthiness of the company. SOEs have had virtually unlimited capital and have invested with gay abandon in roads and bridges to nowhere. No more. Efficiency or quality of capital allocation is now a key theme in China. And this is very interesting for us and for you as participants in financial markets. Because the Chinese government now need you. They need sophisticated foreign investors to help the financial markets become more efficient and to help the market price, credit, and equity risk. So China is opening up its financial markets. There is now a system in Hong Kong called Stock Connect, and there's one called Bond Connect. And as long as you have a bank account in China, you can now move your money, a bank account in Hong Kong, you can move your money into the bond and equity markets of China freely, and you can take it out. Now, bond and equity index providers have noticed this, and 2018 is a hugely significant year because this is the year when China arrives in global financial indices, in equity indices and in bond indices. In May this year, MSCI will include the shares of 222 A-share companies into their emerging market equity index. And at about the same time, JP Morgan, Citibank, and Barclays will start to include Chinese government bonds into both developed market and emerging market bond indices. Deutsche Bank estimate that somewhere between $700 and $800 billion of offshore money will flow into Chinese bond markets over the next 5 years because of this index inclusion. And the bonds are attractive. 10-year Chinese government bonds yield about 4%, agency bonds yield about 5%, and the renminbi is one of the least volatile currencies in the world. So 2018, as we look forward, is a huge year for China. It's a huge year for investors and for financial markets and global indices. The arrival of China on the world financial stage. And it's all because of these blue skies over Beijing. Now, I know that many investors around the world use bond and equity indices to think about the investment horizon and the investment universe. And I want you to compare this slide with the slide that I'm going to show you next, because this is the economic reality that economists like Paul are dealing with every day. The blue line is the United States share of the global economy, which is still incredibly large, and it's still the most important economy, but its share is coming down. And over the last 20, 30, 40 years, the most important part of this chart is the green line, which is the rise of Asia, supported by the dark line at the bottom, which is the rise of China. India's beginning to wake up, as I'll talk about in a little bit. But as Paul mentioned, there are other enormous economies beginning to stir in Asia. Indonesia, with almost 300 million people. Philippines, with 100 million people. Vietnam, with 80 million people. Bangladesh, Pakistan, and India. And it won't be long until Asia is 50% of the global economy. Compare that economic reality with the financial reality that you all face. On the top, I have two global equity indices. At the bottom, I have two bond indices. The dark blue is the United States. Look at America's dominance of equity indices, 50 to 60%. Look at America's dominance of global bond indices, 30 to 40%. look at the West, include Europe and Japan. Can someone please try and tell me China? Can you find China there? Can you find Asia there? It's a sliver. Ladies and gentlemen, this is ridiculous. All I can promise you is that if I come back and Tommaso invites me back in 5 years' time or 10 years' time or 20 years' time, these charts will look very different indeed. And the share of China and the share of India and the share of Asia will be much bigger. So the choice for you as investors is you can sit and wait and do nothing and finally buy China or India or whatever it is when it goes into the index, or you can move now ahead of the index inclusion. And my suggestion is that you start to think about moving now, because by the time all this gets into the index, those prices are going to be substantially higher. And let's think about it with all the QE that we've had in the West for the last 10 years. It's not exactly as if you're selling shares in Western companies or bonds issued by Western governments at low prices. You are selling at incredibly high prices. And the main difference between Asia and the West is that Asia continues to have broadly orthodox economic policy. The choice is yours. You can imagine what I've done with my own portfolio. Very quickly on Asia, it's very big. It's where half the people on the planet live. If you've never been out there, please come and see us. It's going to be 50% of the world economy by 2050. It's savings rich. And it's not a uniformly good demographic story, but some of the best demographics in the world are in ASEAN, in Southeast Asia, and in India. And it's very interesting, within Asia, capital is flowing north to south, out of countries with bad demographics like Japan and China and Taiwan and Korea, into ASEAN, Philippines, Indonesia, Vietnam, Bangladesh, and into India, countries with great demographics. And the real story about Asia, of course, is this: it's productivity. You think about how inefficient an economy like India is, the potential to apply technology there. No wonder the potential for productivity growth is so fantastic. And of course, what is GDP growth about? It's numbers of people times what they produce. Asia wins on both criteria. Balance sheets are strong in Asia. Most countries are in current account surplus or very limited deficit. Foreign exchange reserves are absolutely enormous. Governments aren't bloated by these unfunded pension liabilities that blight the balance sheets of governments in the West. Asia did have a crisis 20 years ago, but they've made the repairs, they've undertaken the painful structural reforms, and they didn't print money. And frankly, they're very surprised that the Americans, the Brits, the Europeans, and the Japanese did, because these were the people who went out to Asia in 1998 and said, no, you can't print money in response to a crisis. The only country that does that is Zimbabwe, and look what happened to Zimbabwe. Asian currencies, the least volatile in the world. When I come to Europe and to the Americas, many people say to me, Don, I can't invest in Asia, it's too risky. Well, ladies and gentlemen, what about the euro? A year ago, nobody loved it. Now everybody loves it. My currency, sterling, everybody hated it. Now everybody loves it. Everybody used to love the dollar. Now they hate it. Aussie dollar, Canadian dollar, Swiss franc. These are the currencies that are bouncing around in the world financial markets. If you look at a chart of the least volatile currencies in the world, the least 10 volatile currencies in the world are all in Asia. And broadly speaking, Asian assets are inexpensive. What we've seen over the last 6 or 7 years is huge multiple expansion in the West. Multiples in Asia and emerging markets are a little bit higher, but not excessively so. So if you're thinking about investing in the stock markets of Asia and you're worried that they rallied 30% last year, yes, they did. But I can't say hand on heart that they're expensive. And I can say hand on heart that we expect a lot more economic growth in that part of the world. Finally, on India, I've been to Italy for several years now, preaching about India. It is still our favorite story. It is the best reform story on the planet, not just in Asia, not just in emerging markets, but in the whole world, because of what Prime Minister Modi is doing. But Modi is only 20% of the story. The real story in India is the Reserve Bank. The Reserve Bank of India, for the first time in the country's history, is now targeting inflation of CPI of 4%. This in a country where CPI has traditionally run at 10%. In a poor country, inflation is tax. It's a tax on poor people. And the government gave the central bank this mandate to bring down the taxation on poor people to help raise their living standards. The implication for financial markets is extraordinary. The potential in India is for the whole term structure of interest rates to come crashing down. 10-year bonds in India today yield 7.5%. It's ridiculous. We think the term structure of rates can come down, and if that happens, then the discount rate for cash flows from Indian companies falls from a double-digit number to a single-digit number, and the stock market will be off to the races. And if the stock market is rallying and the bond market is rallying, then the currency is going to be very strong as well. India today is where the United States was in 1980 with Volcker and Reagan. In India, we have Modi and a guy called Patel, who's now running the central bank. Back in 1980, inflation in the United States was double-digit. The 10-year Treasury was 15%. And the S&P 500 equity index, which today, last night, closed at 2,850, in 1981, it was at 110. So the financial implications of a country starting to fight inflation are incredible. If they're successful, and we believe India will be, inflation comes down, bond yields come down, and stock markets do well. Now, as introduced by Tommaso, I'm a salesman. You would expect me to be bullish. So why don't we call on a professional fund manager to come up and give a real view of the world. But Mr. Brooks is a very interesting character because I think he might agree with some of my conclusions. Thank you very much and good luck in 2018.
Thank you, Don. Okay. I don't know how long it's going to take me to get through your slides to get to mine, but here we go. Here we go. We got here. So as Don suggested, we invest across a very wide range of asset classes, including Indian bonds. And we maybe come back to that later. But what I wanted to talk to you today about is where we are seeing the most attractive investment opportunities. And the key message is that we think traditional asset classes are facing a challenging outlook. But the good news is we're seeing a lot of attractive investment opportunities in a range of alternative assets. And I'm going to talk through, not only are there attractive opportunities, but they're also more accessible to investors and can be invested through daily dealt UCITS funds. So I'm going to chat through, first of all, how we see the outlook for some of the traditional asset classes, and then move on to these alternatives and give some examples of where we're seeing some really interesting opportunities. So the first few charts I'm going to bring up and the first few slides build off our long-term investment outlook. So this is a very thorough piece of work that happens within our strategy and economic research team that Paul and I are closely aligned to and work with. And it covers a very broad range of asset classes. But we'll look at the main asset classes that people are most interested in. Now, Paul talked about our central view of positive economic growth, this Goldilocks economy, but risks to that. And he touched on the fact that valuations were somewhat stretched in equity markets. And here's a couple of charts that support that view. So one of the more commonly used measures of equity valuations, the Shiller cyclically adjusted price-earnings ratio, is showing that the US market is at the most expensive level it's ever been, apart from the tech bubble of 2000 and the Wall Street crash of 1929. And when we look at different measures of valuation and look over shorter periods of time, again, we're seeing valuations that look expensive in the US and to a lesser extent, but still expensive on other regions as well. And the other thing that worries us to some degree is that these high price earnings ratios are a time when profit margins are at pretty high levels. And profit margins tend to mean revert over time. So if profit margins come down, then actually you not only have high prices to current earnings, but earnings could be currently cyclically high. So that is another concern and feeds into our expectation for equity markets. And it's not only equity markets that look expensive, but credit markets don't look particularly cheap. So high yield bond spreads are now at lower levels than they have been at any point since the financial crisis, pretty much. So whilst our central view in the short term is for this Goldilocks economy, in which case equity markets probably will still continue to go up, there's a range of scenarios that could play out, and Paul talked to these, some of the downsides, and we think markets could be very vulnerable to these downsides given how richly priced they are. They're priced for perfection to some degree. And clearly, government bonds are not necessarily offering that attractive returns. We've seen the yields of government bonds come back down over the last 25 years and now at very low levels. So our expected returns on government bonds are clearly very low. You can't get the kind of mid to high single-digit returns on government bonds that you had in the past from current yield levels. But the good news is we think there's a much broader range of investments that we can access now. And in terms of this opportunity set, we have equities as part of the opportunity set. We also have lower returning asset classes such as government bonds and investment grade credit available, although not offering particularly attractive returns. But there's lots of interesting stuff in the middle here. So in the blue box is various forms of higher returning credit, which includes high yield bonds, but also includes things like loans, includes emerging market bonds, local currency emerging market bonds, including India, including other areas which we do think are attractive, various forms of alternative financing, and I'm going to come back to a few examples in a minute, asset-backed securities, infrastructure, property, and various kind of more market-neutral areas. Insurance-linked, I'll come back and talk about that. It's quite an interesting area. Now, in terms of our expected returns, so all this work that we do on long-term returns outlook, I've distilled into one chart here that highlights over the next 5 years, our expected return on cash, and this is in euros, is just above zero. We don't expect interest rates in the Eurozone to go up significantly. Return on global equities, 3% per annum over the next 5 years. So we don't think from here that over the next 5 years returns are going to be good. Now, who knows exactly how that will play out, but I suspect the path of least resistance is equity markets to keep going up until one of the bumps in the road does occur, whether that is a China slowdown, whether it's an inflationary pickup or a monetary error, whatever that might be. Government bonds. And investment-grade bonds we don't see as particularly attractive. But there's a number of investments here that we think do offer both attractive returns and diversification benefits. So infrastructure, and I'll come back to talk about one of our infrastructure investments in a minute. Emerging market debt, I'll talk to you, that's one of our favorite areas, local currency emerging market debt. Asset-backed securities, and there's a broader range of assets that we can consider alongside these. Now, I said that these investments are a lot more accessible nowadays. Now, I suspect when I've talked about some of these investments already, you'll be thinking, well, like, these are illiquid. You can't hold these in daily dealt portfolios, certainly not in a UCITS portfolio. But this is where there's increasing opportunity. So I think most people in the room will be very comfortable with the idea of investing in REITs, real estate investment trusts, which is a way of getting access to property, an illiquid asset class, through an instrument that is daily tradable. You buy or sell shares in a REIT on a stock exchange. It's a global market. What people will be less aware of is that exactly the same concept of wrapping up assets and putting them into an investment company that people can buy or sell shares in exists in the London Stock Exchange, covering a much broader range of investment opportunities. So that includes, and we've shown the growth of what's known as the listed alternative market. So these are all investment companies, these are all shares you can buy or sell on the stock exchange on a daily basis, but they have exposure to these range of interesting asset classes that's grown dramatically over the past 10 years. And so it includes around about 15 billion in infrastructure assets. It includes 10 billion in various forms of specialist credit. So asset-backed securities, aircraft leasing, marketplace lending, healthcare royalties, and a range of other areas. And I'll come on to, I'm going to talk about 4 examples of different investments we have in this area. So this is one way of accessing these interesting asset classes, these diversifying asset classes in a daily dealt form. So I'm going to give a few examples now. Firstly, on infrastructure. So this is one listed investment company that we have a holding in. And this invests in social infrastructure assets, also known as public-private partnerships. So these are key assets for an economy that are funded by the private sector. 3 examples of assets that this particular portfolio holds. One is a bridge in Canada. There's schools in Frankfurt. There's a police station in the UK. So schools, hospitals, roads, these kind of key parts of infrastructure. Now these are built by the private sector, but with a contract by the government where the government will pay cash flows for the next 20 or 25 years for that asset. And it's funded by a mixture of debt and equity, but you have this long-term, reliable, government-backed cash flows. So this is a pretty dull investment. There's nothing particularly exciting here. And these investments that we make here, these are all assets that are already constructed, that we're not taking on the risk of building assets. These are all assets that already exist, and they're just yielding this reliable cash flow stream. So pretty dull, but delivering a 7 to 8% return. I like a dull 7 to 8% return. That works for us. And this investment company has delivered in excess of 10% per annum. It's made some efficiencies over a period. And in terms of what could go wrong here, I mean, this portfolio is diversified across a range of different countries as well. The other investments we have in this area are more tilted towards the UK. The UK has more of a history of using private sector finance to develop infrastructure projects. You could have, there is possibly some political risk here, but that's something that we've assessed and we think it's relatively low risk. It's relatively defensive. These cash flows are inflation linked. So we think that's an attractive diversifier. And indeed, when you've seen equity market sell-offs, these actually tend to do quite well. They tend to trade like government bonds. So the actually price tends to go up. Now, moving on to something very different. Insurance-linked securities. Now, the insurance-linked securities market is now about a $80 or $90 billion asset class. It's an asset class where investors earn a return from taking on the risk of insurance losses due to extreme natural catastrophes such as hurricanes or earthquakes. Now, there's two ways of accessing this asset class. There's a listed bond market, the catastrophe bond market, which is about $25 billion. Or you can invest with specialist managers who write contracts directly with insurers or reinsurers to protect against these extreme natural catastrophes. And they will tend to have a diversified portfolio of exposures, so maybe to Florida hurricanes, to Californian earthquakes, to European windstorms, Japanese typhoons. So that if any one event happens, you will lose money on that event, but it won't impact your overall portfolio. The attraction of this asset class is, first, it can offer a very good expected returns net of losses, but also the diversification benefits. Clearly, the risk of losing money here is not correlated to the risk of losing money in equities. And indeed, in 2008, when equity markets and other asset classes sold off, you had positive returns from this asset class. Now, clearly, we've just been through a period where we've had a number of extreme natural catastrophes. We have lost money on our investments in this area. We had hurricanes Harvey, Irma, and Maria, causing some of the biggest losses in history. We've also had Californian wildfires in the last few months causing losses as well. And the California wildfires themselves caused $12 billion worth of losses, which is not just the highest ever in history, it's 4 times the previous highest. So it's been a catastrophic year for this. So we've had negative returns here. No one likes having negative returns. But the silver lining of this, the positive aspect of this, is it's happened in a year when equity markets have been doing well, credit markets have been doing well. So we've lost money on these investments whilst making money on other investments. The other positive is because there's been a destruction of capital in the reinsurance markets, the actual returns you earn going forward are higher. So the investment we've got here, I talk about CATCO. So again, this is a listed investment company. They have almost $1 billion market cap. It insures across a range of different natural catastrophes. It's part of the Markel Group. They typically target an expected return net of expected losses, net of fees of around about LIBOR plus 10. We think over the coming year that's more like 15 to 20%, given the better rates of return they're offering. So we think as part of a diversified portfolio, it makes sense to have exposure to something like this. Moving on to something, again, very different. Litigation finance as an asset class. This is a relatively new investment area. So what this is the third-party financing for commercial litigation cases. Now, the classic example here is, let's say you had a company, a large company steals a small company's idea. The small company sues the large company, and so the large company gets their legal team to drag the case on through the courts for as long as possible until the small company runs out of money and has to settle for a small sum. And indeed, the individual who set up Burford, the company I'm going to talk about, used to be the head of the legal counsel at Time Warner, and that was his job. That's what he used to do. Now, what happens now, the provision of third-party finance allows that small company to say, well, look, I can't afford to fund these potentially very high legal costs, so I'm going to get a specialist financer to come along and say, well, they will pay for the legal costs for a share of the proceeds if we're successful. And that obviously can be very lucrative. Most of the cases are in the US, because in the US, litigation is one of their hobbies. And the potential here is to deliver very strong returns. Now, Burford, our investment, the investment company we invest in, is the largest provider of third-party financing. It has performed extremely well over the last few years. And to help you understand why, I'm going to give you a case study of one high-profile case that they have announced. A lot of the cases they don't talk about for understandable reasons, but one is very much in the public domain. So this relates to the Argentine government in 2012 nationalized the biggest oil company, YPF, made a lot of headlines at the time. That company was 50% owned by Repsol, who came to a settlement with the Argentine government for that stake. It was also owned, had a 25% stake by an investment group, the Peterson Group. The Peterson Group then went into liquidation as a result of that, went to bankruptcy. Now the liquidators for the Peterson Group then wanted to basically sue the Argentine government. They didn't have the money to do it. So they went to Burford and they said, here's our case, here's all the detail. And Burford obviously have a lot of trained legal professionals who can assess the merits of the case, assess whether the party that you're taking the litigation can pay, whether you will win it. And Burford agreed to fund this case. So they committed $18 million to financing the legal costs. About a year after, and this was fought in the US courts in New York, about a year after I think they made that 18 million commitment, they'd had one positive result from one of the court proceedings, and these things tend to go through various stages. And after that, they sold a quarter of the stake in that case for $110 million. So the total value of their case was then valued at $440 million. They invested 18, value 440. And they've realized, obviously, they've sold a quarter of it for 110, so they're obviously in big profit there. We don't know exactly what they're going to get for the other 75%. They think it's worth a lot more than that 440 in total. So you can get incredible upside returns. I think that's at the extremes of what you get here, but they can generate very good returns. Because of that, so we've held this investment for the last 3 years. It has generated returns of 125% per annum over the last 3 years. We do not expect that going forward. We still hold it because we expect a good return. Anytime you see a return like that, it's usually something like Bitcoin, which isn't usually based on some substance, but hopefully the example of actually generating that return on that YPF case, the Peterson case, gives you an example of why it's actually gone up in value, why this is an attractive proposition, how they're building their business out, and why we think this is an issue. And again, coming back to diversification, so not only do we see this as attractive return, but the source of that return is very different to equity markets, to corporate profitability. This just doesn't rely on economic growth. Again, something very different, again, to healthcare royalties. So again, biopharma credit, this is about $1 billion market cap listed investment company on the London Stock Exchange. And what this does is it invests, or lends to biotech companies with that lending backed by the royalty streams of various medicines or drugs that they have. And very briefly, the old model of the pharmaceutical industry was the big pharmaceutical companies used to research and develop and market drugs. The new model is you have lots more smaller biotech firms, research companies developing drugs. And then once they've got them approved, they will then license them to the big pharmaceutical companies who will then market them and distribute them. Now, the biotech companies want to realize the value of that royalty stream so they can reinvest in drugs, or they just want to take profits. But if they wanted to try and realize that revenue stream, banks won't lend to them against some revenue stream they don't understand. They could sell equity in their company, but that's quite an expensive way of raising capital. So you have some specialist investment managers, such as Pharmacon advisors who manage the portfolio here, that will assess the royalty stream, and they will then lend on appropriate terms backed by that royalty. So they will think about to what extent will another drug come along that will take the share. And so they're experts in this field. They invest based on gross returns of something like 10 to 12%, and after they take away their fee, we get an 8 to 9% expected return. And again, very much a diversifying investment, not relying on economic growth, on corporate profitability. So what does that mean in terms of how does that come together? There's a few examples there. How does that come together in terms of a diversified portfolio? We have two flagship funds, the daily dealt UCITS funds, our growth fund and our income fund, where we have a range of different investments. So equities do form part of our portfolios at 18%. Typically, we'd hold something like 20 to 30. We're down below the lower end of that range, given comments earlier. Pleasing to Don will be our liking for emerging market bonds. So we do think local currency emerging market bonds do offer attractions, and included within that is India. But then there's a range of other investments here. I've mentioned infrastructure. The other investments I mentioned are all within our special opportunities bucket. They're quite small, niche idea. I mean, Burford is a £2 billion market cap company now, so that's much more investable. But there's a range of different. We have insurance linked, as I mentioned. That's the CATCO example. But there's lots of different investments that we think are attractive, and we have them as our growth and income portfolios are very similar, because actually, when we invest for our growth portfolios, we're interested in the best risk-return trade-off, but all of the investments I've mentioned come with very good yields. They're all 5% or more, and emerging market bonds is. So we actually generate a very attractive yield without trying in our growth portfolio. So that's what we think diversification looks like going forward. It's one thing that we think, given the challenging outlook for equities and for bonds, that this is a good way to position our portfolio to deliver attractive long-term returns with relatively low volatility and diversification benefits. And just to highlight, we've been running the strategy for over 6 years. The fund, the long-term fund here is our UK fund, but our Luxembourg fund mirrors this, and it's delivered returns of cash plus 6.5% gross, with less than half the volatility of equities. And when equity markets have sold off, various periods of equity market, the fund has been relatively resilient given the diversification of the portfolio. So hopefully that gives you a flavour of how we see the outlook, how we see the opportunities, and where we see the most attractive opportunities are. Thank you.
Well, I hope you got some interesting ideas. Well, maybe the idea of starting with a global view and then try and dwell and zoom in onto different areas such as emerging markets and Asia, which is particularly interesting for us. And then with something we like to stress because it's something which is a bit different from what we see in the traditional markets and what is particularly interesting for us, the multi-asset sector. What I try and do at the end, and then we'll try and also have a debate with you. What I always try to do at the end is to try and sum up. We are in a balancing situation. We, as Paul showed before, we have real data which is generally positive. it's difficult to see the upside of some estimates, but this is the case, it seems. This is what we see, a situation or the continuation of a positive scenario we had in 2017. And then on the other hand, we have another situation where we get many negative news on the market, and they can obviously lead to some higher level of volatility. And this, in our opinion, will, one way or another, also in the course of 2018, bring about some volatility or a slight increase in volatility, which we didn't have in 2017. This is what Mike said before. I mean, in terms of investment strategy, he says, okay, beware of what the scenario can be with the upside risks. We see that inflation is increasing and real rates are increasing. Paul has indicated this. This is something that we might not see that strongly throughout 2018, but it's something that is growing. Rates, this is what Paul said during his presentation. We expect 4 times real interest rates increases in the US market. And so what can the implications be? Well, I got 3 points from Paul's presentation, which in my opinion tend to converge towards some specific investment solutions. He said, don't be too complacent, don't trust too much the real data or the data we have available, so try and be defensive a little bit, such as finding possibilities different from others. So we have to diversify. Then, all in all, I tend to translate this into something which is represented here in the slide. So the idea is that of having an active management approach. We've always been active managers. We've always built our portfolios, also in the multi-asset area, with an active management approach. We try and exploit our skills, and we try and put that into practice. Then find diversified sources of return. And this is what was mentioned by the speakers before. The idea is that if I diversify from the nominal viewpoint within my portfolio, and you know this better than I do, by including new different asset classes in the equity sector with that geographic diversification, and in the equity sector with high yield stocks or corporate investment grade stocks, what we obtain is not a huge diversification. It's just a face-up diversification. What we do in our investment instead is try to have an independent and autonomous approach, which is very diversified and which allows us to include something which is outside the consensus or something that others don't use. This, as an investment solution, leads to what Mike indicated earlier on, multi-asset growth, multi-asset income, depending on the indications. But we think that currently, for a portfolio component, this is very interesting for the way it's built, and also because of the fact that it does not rely, and this is something that Mike doesn't specify, we're not relying on macroeconomic bets. So we don't bet on who's going to win the elections or what the growth of certain countries will be. We try and find investment ideas that can provide yield in the next few years. Yields that obviously must be disconnected one from the other as a trend. And this we see as an advantage in the construction of our portfolio. And the results, for those of you who know them, are there. And so the history can demonstrate this. Further suggestions or maybe further ideas. You might be aware of this already, but just to give you an idea, where do we see value in this case? We don't go with a predefined solution, but something a bit more specific. And so the idea here is that of trying to always look for growth in specific markets. All in all, what I mentioned them all here, and then later on maybe we can go into further detail. What's the main consideration? Well, if we look at equity markets, especially what's happening in some equity markets, our indication is that all in all the market is growing. Growth is synchronized, and Paul said this before. The global market is still cannot be detached from a good performance of the US market that needs to be there. But what we see now is that valuations are very high. Valuations for large caps currently could be a tactical choice given what tax cuts could be in the US. And then again, for developed markets, we can have investments in Japan. And something for the long term to match the journey shown by Don, what we might expect to move quickly. And I know that some of you have already done this and used this on a constant basis, but there are some interesting solutions. One is infrastructures in emerging markets, where also the evolution that has taken place in the quality of air, for instance, or the quality of water, Don's explanation, this leads to a totally different approach with the improvement of infrastructures. And so this is a fund that tends to invest in these asset classes, in these markets, and especially in emerging markets. And the other one instead is for Asia Pacific. Here I've mentioned one, but I could mention more. Within your folders, you have different investment solutions within the Asian market. We have an Indian equity, which in the equity side is very interesting. And we also have China's shares. I didn't mention it here, but it's available for some distributors and not for large distributors. But if you have it in the catalog, have a look at it, because this is a specifically interesting strategy that leads or has offered very interesting yields and still is offering them. And it could be a very interesting long-term investment, given that China is going to access all the indices. And then on equity, well, the idea is that of looking for something providing yields. Mike has shown this to you, and for those of you who haven't seen it, I'll try and summarize. Within the portfolio, the multi-asset, you don't find corporate investment grades or government, and no high yield either. So the bond part is currently only represented by emerging market debt. This might represent a high risk, but in the end it is a representation of what's available on the market today. And so maybe today there's more risk in having government bonds, US treasuries with the rises we have estimated, but also in Europe, because all in all, if rates should go back not immediately to pre-QE levels, in that case, the loss would be significant, with the yield, which obviously is not totally there. And so this is our view as far as emerging market debt goes. This is a fund with select emerging market debts, and the other one could be a sub-asset class for emerging markets in the corporate bond side, because basically we're a bit more defensive there. We're less connected with American treasuries or rates, and it's more connected to the companies in which we invest. And we, given that we have a global presence and we are operational in more than 50 countries, we tend to be particularly good in this reference area. This to give you a general overview, something that can give you ideas for future investments. Following this path, we gave a macroeconomic outlook, then we looked at some markets and some specific solutions. Just a couple of words on what we're doing. Maybe I talked to some of you, but anyway, what's happening? The company is growing. We're also listening to requests coming from the market, also from the Italian market. For those who have invested, well, you probably have seen that during the course of last year and now we're moving some compartments from global to global. What's the idea here? The idea is that of allowing negotiation to become much easier. So we want to become more streamlined. And the other important change we've made is a new denomination on asset classes. Within the folders, you find a new product range. They're denominated in a clearer manner, in a more transparent and simpler manner, at least as far as we believe, and it provides indications about the market. And in terms of future evolutions, we will provide you with a set of products Standard Life had. We don't talk about them today. They're only available with some distributors, one distributor in Italy, but they are strategies that are particularly interesting. Just to mention some, global absolute return, it's a strategy with more than 20 billion of assets under management as a global mass. Then there's a European Boulders company, which is the top when it comes to small cap European investments, and the same is true for investments on Euro corporate or total return credit. These are all strategies that will be available in the short term in your product ranges. We didn't ask you to ask questions to the speakers during their presentations, but they're obviously here now or later during lunchtime. So whatever question you might have for them, Don't worry, because you can ask them in Italian or in English. We will translate this simultaneously, or otherwise I'll translate. But anyway, if there's something in particular that you didn't touch upon or something you want to dwell upon, please go ahead. Microphone, please, though. We'll give you the mic so that simultaneous translation can be provided. Thank you. Yes, I wanted to know a bit more about the role of technology. We will see this very strong power of the 5 US companies that made the whole of the performance in the US last year, or will there be something different, maybe coming from Asia? And if so, apart from Alibaba, which will be the drivers? I mean, will technology still play a major role in 2018?
Address a little bit, but I think I leave to Don to give some an Alibaba point of view.
I can start. So part of the question is who benefits from the US tax reform? And I think it's largely, it's actually a lot of large companies benefit from the US tax reform, in particular those with large overseas earnings. And a lot of technology companies, in particular Apple, are big beneficiaries of that. But, you know, the US growth story is a very broad-based story as I try to present it. So it's about an underlying labor market recovery. And to me, that speaks to gains across the US equity market, you know, of all size companies. But with the big caveat that it seems like the initial primary beneficiaries of the tax reform are those with large overseas cash piles, and a lot of those are the large technology companies. But we've already seen that kind of positive impact occur. Maybe Don has more in Asia.
When it comes to the markets in Asia, we have our equivalent of the FANGs. In Asia, they're called the BATs. So that is Alibaba, we have Baidu, we have Tencent, and we have Samsung, and actually also TSMC, Taiwan Semiconductor in Taiwan. So for the BATs, I mean, these companies are all doing incredibly well. The only problem is they don't all have tremendous corporate governance, particularly the companies in China. And the problem with investing in technology in China is this: it's illegal. So the only way that Chinese technology companies can issue shares or bonds for you to invest in is through this structure called VIE, Variable Interest Entity. And these VIE structures are based in the Cayman Islands. And actually, when you buy shares in Baidu or Alibaba, companies like that, actually you're buying a share in a shell company in the Cayman Islands that has no assets. Now, investing in companies that have no assets is tricky, because the only contract they have is a contract with the parent company back in Alibaba's case in Hangzhou. So if you buy Alibaba shares or Alibaba bonds and something goes wrong, you go to the court in the Cayman Islands and you wave a piece of paper saying, I'm a shareholder, I want my money back, I want the assets. And the judge will say, I'm very sorry, but there's nothing here in the Cayman Islands. You have to go to Hangzhou. So you get on a plane all the way around the world from Grand Cayman to Hangzhou, and you land in Hangzhou and you go to court and you wave a piece of paper in front of the judge saying, I'm a shareholder in Alibaba, I want my money back, I want the assets of the company. And the judge in the court in China is just going to laugh at you, because he's going to say, no, you don't. You have a share in a piece of paper in a company in the Cayman Islands. You have no claim on anything in China. Get out of here. So the problem is that the Chinese Communist Party, they know that these VIE structures exist. They have not said they are legal. But also, they have not said they are illegal. And this ambiguity, this legal ambiguity, is the way that the Chinese government controls the technology companies. And obviously, if these companies don't do what the Chinese Communist Party wants them to do, or they do something that the Chinese Communist Party doesn't want them to do, then they're going to make a declaration about the structure. Now, we have taken a long time and done a lot of research to try and come to understand this. And Tencent, we are now buying. It's taken us a long time, but we're now buying Tencent because we trust Pony Ma, the CEO of the company, to look after your interests as minority shareholders. Alibaba, we will never buy. Never, ever buy, as long as Jack Ma is alive. Jack Ma, and he comes from the same town as Pony Ma, the guy who runs Alibaba, he does not treat minority shareholders fairly. He tried to take Alipay out of Alibaba and list it separately without compensating minority shareholders. Alibaba last year had their first investor day in Hangzhou. And you know what Jack Ma said? He said, I don't know why these Italians and foreigners get so upset about Chinese companies selling fake products on my website. What's the problem? Chinese fakes are some of the highest quality fakes in the world. We're doing the Chinese people a great service. We make great fake Gucci ties or Gucci jackets or Hermes this, and we sell them at very cheap prices. It's great. Okay. So you cannot deny technology, but you have to be very careful about the way you do it. We love Samsung in Korea. We love Taiwan Semiconductor, and we are beginning to fall in love with Tencent, but you have to be very careful. Mike, do you want to say something about the fact? Okay, sorry. Sorry.
Prego. Manu, c'è te.
Sì, buongiorno. Volevo solo chiederle una cosa. Lei ha accennato qualcosa sulle criptovalute, sul Bitcoin. Ho visto che i primi provvedimenti che le banche centrali asiatiche hanno preso hanno comportato.
I've seen that the first measures taken by the central bank of Japan have actually caused a fall in the value of Bitcoin. What's your opinion about it?
What do we think about Bitcoin?
Cryptocurrency, and especially
Well, shall I
what is
start?
going on?
I mean, we all probably all have an opinion on Bitcoin. Look, the simple line for me is that the attraction lies in the underlying blockchain technology rather than the Bitcoin asset itself, if you can call it an asset. I mean, for a fundamental asset manager that looks at investments on the cash flows they deliver on the fundamental value of the asset, that is what Don talked about, that's what Mike talked about. We have to say, well, Bitcoin does not display those characteristics, does not deliver a fundamental return stream. So it seems to us very simply that it must be a speculative asset. Now, that does not mean that it can therefore rise a lot. Speculative assets, of course, can, and it has. But what the real attraction is the blockchain technology that powers Bitcoin. And that seems to have a lot of uses. It seems to have medical uses. It seems to have uses in smart contracts, in keeping records safe. I mean, essentially, it solves a problem, which is trust between counterparties who may not trust each other or ever meet each other in the real world. And this technology seems to have widespread applications. And that's kind of what I would be interested in as an investor, the potential for that technology, rather than the kind of the cryptocurrency itself.
Yeah, I'd agree with that. I think blockchain's interesting, Bitcoin, speculative bubble. To have anything, I think the concept of Bitcoin when was that you could have central banks inflating away fiat currency. So by printing money, you could inflate away the value of the dollar or any other currency. So having something else as a more stable source of value would make sense. Obviously, the moves you've seen in Bitcoin over the last year completely defeat any argument that it could be a stable source of value and therefore serve as any kind of currency. So if it doesn't have value as a currency, it can't have any value as anything else. So, no idea, it's guesswork as to where it will go, but it doesn't have any intrinsic value. So I wouldn't touch it personally.
Think that Bitcoin, as Mike said, was meant to solve a problem of potential hyperinflation in a currency. And what Bitcoin's actually experienced is hyperdeflation. So the price of a good in Bitcoin has gone up enormously. So that's hyperdeflation, is what Bitcoin has experienced, and that just can't work as a currency either.
Got two questions. One, basically, you highlighted the link between Hong Kong and China on the shares, and now we are approaching bond inclusion in the indexes. Contrary to economic norms, that link has actually widened the AH spread instead of tightening that. Are we sure on the bond side we will witness something different? And on the second question, given what you highlighted, government control or quasi-control of what we are talking about, are we in the same position on the China bond as the government, i.e. the government wants us to be in and to be financing their bond market, or is a kind of, not welcome people into that market? Because in this country, I think this kind of considerations hold a strong importance.
On the A-share, H-share differential in the bond market is very different. There has been an offshore bond market in China, the dim sum bond market, and renminbi in Hong Kong has a different currency ticker. It's CNH rather than the onshore currency that is CNY. And the offshore currency, the CNH, the dim sum bond market, that was an experiment. That was the Chinese government creating a mini bond market to try and see how it worked and how foreigners might use it. Now that there is the Bond Connect system, the CNH market is dying very rapidly. Issuance is just collapsing, and everyone is going onshore. So I don't think you'll have different issues. You'll just have the natural death of the CNH bond market in Hong Kong. In terms of foreigners coming in, absolutely. Actually, the Chinese government are more excited about Bond Connect than Stock Connect because there's more money in the bond market to come into China than there is in the stock market, given that the weighting of A shares in MSCI is only going to be 0.75% of the index, and it's only a 5% weight of the free float of the 222 companies that are going in. They want a lot of foreign money to come in because there's a lot of domestic money in China that wants to go out. And the money that wants to go out is just a pure diversification play. Chinese institutional investors, particularly the insurance companies and the pension funds, have most of their investments in Chinese stocks and bonds. That's a very dangerous level of concentration for anyone. So the central bank is going to act like a traffic policeman. It's going to try and get money coming in this way and then money going out that way, with the currency broadly stable in the middle. So you're going to be very welcome. And the key point is that through this Bond Connect system is you can get your money out. With previous methods of access into Chinese bonds, QFII, RQFII, there was a process to get your money in, and then there was a process to get your money out.
Altre domande? Prego.
Any other questions? What's your opinion about the value of the dollar? Many people say that it's difficult to understand that considering that the U.S. economy has a very low or almost zero unemployment rate, it is strange that the American company is getting away from these macro values. So people are growing concerned about the dollar being depreciated as an intentional choice of American policymakers, because they think they might be useful for boosting exports. Some economists say that they cannot believe what is going on, whilst some other people are saying, but it's not the euro getting stronger, much stronger than the other currencies. So that's why I'd like to know what you think about this.
I think the dollar question is an extremely important one. At the start of last year, the consensus on Wall Street was basically it's a year of dollar strength, and that did not happen, as we know. The consensus at the start of this year, it's a year of euro strength, and dollar weakness has suddenly become the consensus view. And the argument for continued dollar weakness would be that it's no longer the case that the US is so far ahead in its business cycle relative to the rest of the world. So now we have the ECB gradually turning to tightening as the European economy does well, and then other economies are catching up the US business cycle as well. And the other argument is, as you said, that now it seems that there may be some kind of semi-official policy coming out of the Treasury for a weak dollar as well, because it helps Trump's trade agenda. I don't find either of those arguments particularly convincing, actually. I think that positioning is overly stretched now in the euro relative to the dollar, so that tells you that there's already reversal risk there. I think that output gaps matter, so it matters that the US is further ahead in its business cycle, probably does have more underlying inflationary pressures. It matters that I think the Fed will hike 4 times this year, and the European Central Bank won't be hiking until next year. And I don't think that official Treasury policy towards the dollar matters all that much. So I don't think it's particularly influential for the longer term that Steve Mnuchin has said that we're kind of fine with a weaker dollar. What tools does the Treasury actually have to control the dollar? I mean, it's largely governed by what the central bank does, what the Fed does. And we're yet to see whether Trump will be intervening with the Fed or not, but it's my expectation that, broadly speaking, they do what inflation and what growth tells them to do, which is gradually hike interest rates. And there's also another wild card that could create dollar strength, which is repatriating foreign earnings back to the US. And most of these earnings are already held in dollars, so they're unlikely to have much of an impact on the dollar. But there is a small minority of analysts I talk to who tell me, no, actually a lot of these foreign earnings are not held in dollars. And once they're converted back into dollars, that will be a dollar tailwind as well. But that's a kind of wild card. By and large, to me it seems that whenever I hear that the consensus is all positioned one way, I start to think, well, is there value in a contrarian position there? And in this case, it seems to me there is.
Mike, Don, do you want something?
The only comment I would make from within the funds that I manage, we hedge currency exposures. We have our emerging market bonds in local currency. We have that as a kind of more strategic position, but we don't have views. So we don't have a position on the dollar or the euro or the yen. There are other multi-asset funds within Aberdeen Standard Investments that do have more views on currencies, and the likes of GARS and some other strategies, but it's not something. So I can't offer a view over and above the well-articulated view of Paul on that issue.
Yeah, I think the only thing to say from an Asian point of view is we are broadly constructive on Asian currencies against a broad basket of developed market currencies. And particularly currencies like the rupee, where you have very high carry to protect you on the downside. I think North Asia is susceptible to Trump's trading tirades. Asian currencies are managed, and you can see a shift in policy towards tolerating stronger currencies. I think the only other issue is inflation and commodity prices, and obviously commodity prices are still priced in dollars. Asia is a big importer of commodity prices, so there is every incentive not to let currencies weaken at the moment, because if you have higher commodity prices and a weak domestic currency, then that's going to import inflation and that's going to cause domestic problems. So with commodity prices rising again, actually there is that added incentive for many countries in Asia to keep their currencies strong.
Io a questo punto...
Well, at this point, there's another question at the back. Maybe we can do it later if you can stay. So lunch is being served just outside here. So thank you very much for your participation. Thanks to all those who followed us via streaming, and thank you again.